All right, let's dive into a topic that's, well, it can be really tough, but it's so incredibly important to understand. We're talking about the adoption tax credit. And more specifically, we're going to tackle that painful question. What happens to that credit when an adoption, for whatever reason, fails to go through? So let's just get right to it. You've poured your heart, your energy, and a significant amount of money into the adoption process, and then it falls through. It's devastating. But on top of that, is all that money just gone? Is that potential tax credit completely off the table? Well, here's the thing. The answer is not a simple yes or no. It's a really surprising yes, but. And trust me, that but makes all the difference. You can often claim the credit, but you absolutely have to know the rules because they can be tricky. Okay, so to really get this, we've got to start by busting a huge myth, a misconception that honestly, even some tax professionals get wrong. The common wisdom out there is pretty straightforward. If you don't walk away with a finalized adoption, you're out of luck. The thinking goes that all those expenses are just lost. But you know what? That's not the whole story. Not by a long shot. Because when you actually dig into what the tax law says, you find a very, very different picture. And this right here just lays it out perfectly. Most people think it's all about the final outcome. But the legal reality, what we'd call the forensic view, is that the IRS code cares about your intent. It's about whether you made a genuine, good faith effort to adopt. So what in the world is a good faith effort? Well, think of it like this. It's a documented, provable attempt to adopt a specific child. This means if the adoption fails because of something totally outside your control, say the birth parent has a change of heart, your expenses aren't just automatically disqualified. The whole game is about proving your effort. And now we come to what is, without a doubt, the single most important distinction in this entire law. Getting this part wrong is a huge financial pitfall, and for good reason, people call it the trap. Here it is, plain and simple. For a domestic adoption, meaning a child who is a U.S. citizen or resident, you can often claim the credit even if it fails. But, and this is the trap, for an international adoption of a non-U.S. child, the rules are way stricter. The adoption pretty much has to be finalized. And this isn't just an interpretation, it's written right there in the tax code. This is the exact language that creates the trap. It's the reason there's so much confusion. It all depends on where the child is from. Okay, so let's say you do qualify. It was a failed domestic adoption. The next big question is, when do you actually claim the credit? Because the timing here is very, very specific and maybe a little counterintuitive. It all comes down to what's known as the year after rule. You can't claim the credit in the same year you paid the bills if the adoption didn't finalize. You have to wait and claim it on the tax return for the following year. Let's make this crystal clear with an example. Say you paid $5,000 in adoption expenses in 2023, and the adoption, unfortunately, fell through later that year. You don't put that on your 2023 tax return. Nope. You have to wait and claim that credit on your 2024 taxes, the ones you file in early 2025. It's a mandatory delay built right into the system. So if the whole key is proving your intent, what kind of proof are we talking about? This is where you have to think less like someone just filing taxes and more like a detective building a case, because it's about way more than just keeping receipts. You've got to build a file. We're talking about all the emails and letters with your agency and lawyer, the legal contracts you signed, even if they were later terminated, travel records, like plane tickets for visits, even medical evaluations for the child. This is the stuff that tells the story and proves you were serious. All right, let's switch gears for a minute and talk about the numbers. What's actually at stake here, financially speaking? How much is this credit really worth? For the 2025 tax year, the maximum credit is a really significant $17,280 per child. I mean, that is a powerful credit that can make a huge dent in the high cost of adoption. And here is a massive change coming in 2025. For the first time, part of this credit, up to $5,000, is going to be refundable. Now, what does that mean? It means even if your tax bill is zero, you could still get that money back from the government as a cash refund. That is a real game changer. Now, it's important to note that the credit isn't available to everyone. It does phase out as your income goes up. For 2025, that phase out starts when your modified adjusted gross income, your MAGI, hits about $259,000, and the credit is totally gone by the time you reach about $299,000.
But there's one more crucial and kind of sneaky detail you need to know about how this credit works. It's something that can catch a lot of people by surprise, and it's called the double torpedo.
So here's the deal. The credit is great because it lowers the final tax you have to pay. But, and this is a big but, it doesn't actually lower your income on paper for other calculations. That means your income might still look high enough to make more of your Social Security benefits taxable. And it won't protect you from those high-income Medicare surcharges either. It's a really critical thing to be aware of for your overall financial plan.
So after all this, after all the rules and the numbers and the exceptions, it really boils down to this one simple question. It's not just about what you spent, it's about what you can prove. Is your paper trail, your forensic evidence, strong enough to tell the story of your good faith intent to adopt a specific child? Because that, right there, is the key.